Bangor University is the UK's #1 university for research in accounting, finance and banking. And together with our partners at the Chartered Banker Institute, we provide the home for the Chartered Banker MBA. One of the things we provide for both our students and banking professionals are a series of continuous professional development or CPD events. And this film was made at one such event. Professor Molyneux, could you characterise for us what have been the key factors that have influenced things in the last 5 years or so of the banking industry?
Well, yes, I mean, over the last 5 years there's been a turmoil from the banking sector in the UK and the US, going from the most profitable banking sector for over 30 years to a crisis that culminated in the collapse of many banks and bailout in 2008. To a period of re-regulation and more regulatory oversight and a whole array of plans to restrict banks from taking on excessive risks and causing the problems that they've caused in 2008. So we've really gone through a full cycle.
And what have been the main drivers in your opinion?
First of all, there was aggressive risk-taking by banks. Secondly, financial innovations that were banks were enabled to undertake various securities activity with low capital backing, where they didn't fully understand the risks related to the mortgage market that funded a property price boom. Yep. And thirdly, also the strong pressures of shareholders for banks to create these returns was actually forced banks to take on excessive risks as well. So, you know, there's high levels of profitability encouraged by shareholders. Banks look for increasingly complex ways of generating returns, and everything looked really good until there was a meltdown in the stock market and the mortgage market. And so now, with the collapse of the banks, the adverse effect on the macro economies of the Western world, we're now looking at ways to rebuilding the banking sector and trying to put rules in place so the same thing doesn't happen again.
Professor Phil Molyneux.
UK banking, we've seen a substantial decline in the number of institutions from round about 600 in the mid-80s to round about 330. And when you have a decline in the number of banks, if you looked at most banking systems in the developed world, you'd see a similar trend. So it's not a particular feature of the UK. When you have a decline in the number of institutions, then typically you have greater concentration in the system. So a handful of banks take on a more dominant role in terms of market shares. The only trend where you don't see a decline in the number of institutions typically tends to be in emerging markets, where you see a decline in the number of domestic institutions through consolidation, but there's been quite rapid foreign entry, so you see an increase in the number of banks in many of the emerging markets. Subsequently also, employment in the UK banking sector has fallen in recent years, particularly post-crisis 2007, 2008. But we can see quite interesting trends, particularly with the increase in other overseas banks, basically European banks moving to London, actually. What this highlights really is a feature of UK banking. Unlike many other major banking markets in Europe, and really the US and Japan, the UK really has a bit like a dual banking system, because half the banking sector are UK incorporated banks in assets terms, and the other half, if not more, of the banking system relates to foreign banks and foreign currency denominated activity. As we know, we've had a big expansion in the asset size of the banking system. So we can see half the UK banking system actually is activity in non-sterling business, and basically that's all activity here. You know, London is a major foreign exchange market. That's why we have a lot of foreign banks here, and that's why more than half the assets of the UK banking system actually is foreign currency denominated activity, not sterling. And we get a similar picture if we look at the liabilities side. Again, only a certain proportion of sterling denominated activity, and this rest is foreign currency. But we can see big lines going up. Okay, so that gives a snapshot of the balance sheet features of the UK. Poor old manufacturing, well, I don't know if we make much in the UK anymore, but we certainly don't lend much to manufacturing. This is manufacturing here. This very small line at the bottom. But other industrial lending has had a steady growth in nominal terms, but you can see manufacturing is pretty flat. And then we see this big increase, which we're all aware of, in mortgage lending here during the 2000s. So we can see actually, relative to other forms of lending, the share of lending to the mortgage sector has increased substantially over the last decade. So when there's talk about excessive lending to consumers, in one factor relating to the collapse of banks in 2008, well, you could say, well, it wasn't actually excessive lending on the consumer credit side because the UK banks had tightened their credit standards way before. However, the story is, this is where the problem was. Again, we see a cycle in mortgage lending dominated by lending, net new lending by the building society sector, the mutual sector. Of course, some of the major building societies converted to banks, and then we see this explosion of net mortgage lending by the banking sector, you know, to a certain extent, well, fueled, of course, by securitization activity, because they could never have grown net lending at that rate if it had been funded by deposit growth, you know. And then we see the emergence of some specialized mortgage lenders, and then the big downturn, 2008, 2009. And what we've also witnessed up until recently on the income side is we've seen a decline in bank dependence on margins. Net interest margins been falling. The major British banking groups up until 2006, although it's been increasing since, and it's a bit flat the last couple of years, and a general increase in non-interest income, although a big downturn with the collapse in markets in 2000. So we've seen this, and now we see a greater emphasis to a certain extent on margin compared with, well, maybe balance with non-interest income. Okay, but the general trend in all European markets has been a fall in margin from traditional deposit and lending business, and a general increase in non-interest sources of income, and now there's somewhat of a balancing out. There's a debate as to when the financial crisis hit, but generally problems in the US subprime market in 2007 are widely cited as the start of the crisis. And concerns about the US subprime. Actually, HSBC were one of the first banks to report. They reported quite large losses of provisions for household in 2007, quite substantial, so they were ahead of the game. Of course, concerns about the creditworthiness of subprime mortgages spilled into the prime area, and then banks suddenly started to become concerned about who held what securitized assets, and so there was various liquidity shortfalls. The first major bank failure, surprisingly, despite the problems emanating from the US, was Northern Rock, but we all know emergency support from the Bank of England in September 2007. Well, it was revealed, that it had sought emergency support, and then there was a run on the bank and it lost over $1 billion the following day. The government had to step in to guarantee depositors' savings, and eventually Northern Rock was nationalised in early 2008. The report into the failings of Northern Rock, as you all recall, cited a reckless or feckless, maybe, business model, over-dependence on short-term wholesale funding, and problems in regulatory oversight. And starting from then, really, this spawned a sort of a spiral of problems with the UK banking sector and various regulatory responses, some of which it was difficult to keep up to date with. But in the first quarter of 2008, a lot of mortgage products were withdrawn from the market, and by April 2008, around about 20% had been withdrawn, and there was no 100% mortgage. So that was the end of the 100% mortgage by April 2008. Property prices began to fall, the first fall in 12 years. Banks stopped lending to one another because they were unaware of the credit risk of their counterparties in the wholesale market. Primarily, they were uncertain as to the scale of securitized assets held by their counterparties. And then really, the story in a nutshell can be characterized from 2008 to today, really, by a series of special liquidity schemes aimed at A, propping up the banks, and then a bit later propping up the UK economy.
I mean, clearly there have been some winners and some losers in this, in terms of the impact that it's had, from the one extreme of nationalised banks to the other extreme of banks that seem largely untouched. Why the difference?
Well, I mean, the banks that were most adversely affected by the banking sector collapse were those most heavily involved in this innovation activity, which was related to issuing securities backed by mortgages and building up big portfolios of these securities that at one time the banks thought were valuable, and then discovered they were valueless, and so the banks have had to take big losses. So, and the banks who tended to engage in these activities in the UK were the banks that weren't diversified internationally. So you know, the banks that took the biggest hit, RBS, yes, it had bought a Dutch bank, ABN AMRO, for too much, but that was badly hit. Lloyd's, HBOS, that was very badly hit. But the banks like HSBC and Barclays, although they were engaged in quite a lot of this business, they have their very large overseas activity that accounts for more than 50% of their income. So they were less pressurized to do this type of risky activity because they were making good returns from outside, whereas poor old RBS and Lloyd's, the returns from their domestic business activities weren't too strong, and so to boost returns they engaged in this risky activity that eventually resulted in these big losses. So that's the story about the big banks. The smaller banks, actually, they fared relatively okay.
You'd include building societies, I guess, in that smaller bank.
Well, the smaller ones, the smaller building societies, yes. But I was thinking, well, it's not just a UK phenomenon. If you look in Europe, if you look in the United States, who are the banks that didn't suffer enormously during the crisis which culminated in September 2008 with the failure of Lehman and the bailout of various banks in the US and Europe? Well, the banks who fared okay were the little small banks that stuck to their retail activities, lending to small business. They didn't get engaged in this racy securitization business or investment banking, or weren't engaged in wholesale business. So they weren't engaged in the most risky areas and most volatile areas of banking business. So they're the ones that have fared okay, and they're still in existence and are still faring quite well.
Hindsight's a wonderful thing. If we could go back in time and you were sitting in front of a CEO and advising them, what would you be telling them to do differently?
Well, that's very difficult, because if you look 5 years ago, UK banks were the most profitable in Europe. I mean, trying to stop the party when everybody's having a great time is actually a very difficult thing to do. I mean, if you look at the crisis, some people say where, you know, interest rates were too low, so that was encouraging a lending party. The banks were, you know, raising funds through the securitization activities. There was a lot more money to lend on mortgages. Well, nobody wanted to stop the mortgage lending property that was boosting house prices, creating a house price boom.
Yep.
So it's difficult. I think all you could say, really, advise a CEO and say, well, we have seen it all before. Ever since we've had property, we've had banking collapses. You know, banks believe property is safe because it's collateralized lending. But we can point back to a property collapse in 71. We can point to a property collapse in 88, 89, 90. You know, bank booms and property house price booms go hand in hand, and sooner or later the party stops. So all you could advise is saying, well, we're doing very well, we're seeing these phenomena that we have seen before. The details might be different, but we've seen this. So really one should start to perhaps thinking about being a bit more cautious on expanding your lending, but one should perhaps be a bit more cautious about managing the risks in certain areas of your business, because sooner or later the bubble will burst. The problem is, you know, it's difficult for people running banks to make those decisions, because, you know, if they start to recoil from business areas that are highly profitable, their shareholders will be on their back saying, well, what are you doing? So it is a difficult balancing act, but I think know their history and be aware that when you have booms, you always have busts.
So that's the bad stuff, a lot on the bad stuff. So when Phil earlier on said we're going to watch a movie, he didn't say it was going to be a horror movie. So I'm sorry to be a bit negative about the banking's experience, bad times in the UK. But now back to the good times. There's a very nice broker's report, 220 pages of it, from Deutsche Bank that came out a couple of months ago. But there's other brokers' reports the same, looking at the performance of UK banks. And what stands out spectacularly is actually the profitability, the return to profitability of retail banking. You know, so although RBS have posted sort of a 1.6 billion loss last year, if you strip out all the horrible stuff, actually their retail banking did fantastic. You know, so. For the major UK banks, you know, if we look at where does the income come from, people say banking's complicated. No, it isn't. It's just that, well, here's the income from your margin, here's the income from your non-interest margin, seems to be going down a bit post-crisis. Your cost-income ratios, well, that's one area where we have seen a modest decline, big increase in impairments, provisions. But the bottom line is, the capital that you need to have to support retail banking is substantially less than other areas of your business. So if you use ROE relative to core tier 1 capital, according to Deutsche, the UK banks are posting returns hovering around the 20% at the moment. And to be a bit more controversial, if we look at the banks, maybe one of you can tell me, I should have looked into it in detail. Poor old cooperative doesn't seem to be doing great in terms of the return on 10% core capital from retail, but actually the Barclays, HSBC, all the major banking groups, RBS, are doing fantastically from their retail banking. Might even come as a shock to you, maybe. And what's also interesting, surprisingly, is sort of relatively newer entrants, the supermercados, the supermarkets, Tesco, Sainsbury's, they're also posting sort of very, very high returns from their retail banking activity. So to tar all the banking with the same brush is a bit unfair, and certainly the 10A from Deutsche Bank's detailed survey and other brokers' reports is retail banking is doing very, very well in the UK, and the banks are performing very, very well. It's just, I guess, as we all know, other parts of the banks that are doing particularly badly. And what's the most profitable area? Now, this was a shock. Mortgages. What? What? Yes, mortgages, according to Deutsche Bank. And pretty much what drives the profitability, the sector, the most profitable area is the mortgage sector. And pretty much what drives it is its capital treatment. Risk-weighted assets over loans is much lower than in other areas of business. So the returns on the capital backing on it tend to be quite high. So it's the regulatory capital requirements are substantially less onerous on the mortgage book. So if you use return on Tier 1 capital as your performance metric, I mean, you can use others and maybe it wouldn't show up as attractively. If you look at it profits before tax, you see, if you just take so it's maybe playing a game, if you take a profits before tax, actually it looks the least profitable compared with credit cards, personal lending. It's basically the capital treatment of your mortgage book. If you use, and the return on assets from your mortgages is the lowest as well, but it's basically the capital treatment means that it generates this very high return. So that's interesting as well. And what's also interesting is, and again we come back to competition issues, what's also interesting is, I know there's some people here from Lloyds. Lloyds banks seem to dominate the market in terms of market share in the retail sector. Quarter of the UK mortgage business, according to Deutsche. 18% of credit cards behind Barclays. Largest market share in lending. A quarter of total consumer credit business. Nearly a quarter of deposits. A fifth of branches. Now, why am I saying this? Now, this is my tenuous link. We go back to these sorts of figures. It's related to looking at competition in the economics literature. In the good old days when people looked at competition in markets, they tended to look at concentration, market shares, you know, how much of the market do you have? If you've got a big market share, then you must be operating in a bad manner or uncompetitive manner. That was sort of a pretty old-fashioned view of analysing competition. A newer view is, well, you look at the way people behave in the market. You don't, just because you've got a large market share doesn't mean you're behaving uncompetitively. You might have a large market share and you may be behaving competitively. So how do you analyse this? Well, you have to look at the pricing behaviour and the cost structure of the banks. You know, are they pricing competitively? Do they look as if they're operating efficiently? So basically, if you look at the behaviour, or one measure of competition for banks is looking at their conduct, their behaviour, which is looking at pricing, costing, those types of things. Okay, so you might be looking at these types of things to infer competitive behaviour, these types of pricing and cost type variables. Alternatively, the old school looks at these types. Oh, you've got big market shares, so you must be taking advantage of your market position. So these types of things are going to become under greater regulatory scrutiny. You have a large market share, maybe you should divest. We know we've seen divestments from Lloyds and elsewhere, but there'll be greater scrutiny on these market shares and suggestions for divestments and reorganisation of the UK banking sector. So there'll be scrutiny of these types of variables, and there'll be increased scrutiny of the pricing behaviour and other conduct behaviour of banks in the retail banking market to infer competitive conditions.
2012, there are starting to be allegedly some green shoots. We've heard you talk a little bit about the retail banking performance and how that's increasing now.
Yes.
What are the things that are on the priority lists of the leaders, the senior leaders in banking now? What should they be focusing and concentrating on?
Well, half of the UK banking system is virtually under state control, so of course there's a lot of political pressure as well, and the taxpayer wants its money back, so it's in the interest of the taxpayer for the banking system's performance to improve. So that's obviously key, but also I think there's a whole array of regulations that have yet to be put in place as a consequence of the 2008 crisis. We're 4 years down the line. You know, some regulations, new legislation's just been put in place, hasn't been, and there's a whole range of proposed legislation, UK and international, that has yet to be implemented, so there's a priority to get that put in place over the next few years.
One interesting regulatory development that's of course going to have a big impact on the UK banking sector is a report of the Vickers Commission, the Independent Commission on Banking, that reported in, well, there was an interim report last year in March and then the final report in September, that has made various proposals for reform of the UK banking system. And these reforms have to be put in place and implemented, well, we've probably all won the lottery by then and won't worry, by 2019, in a long time. And the proposals of the Vickers Committee relate to ring fencing, separating stable retail banking from more racy and risky investment banking. Of course, the thing with ring fencing, well, it's a great job for our legal friends, you know, what's inside the fence, what's outside the fence, what's the fence, what colour is the fence, etc., etc. So the debate, so it sounds a trivial exercise to define, what's regarded as safe and cuddly and sound there, and what's regarded as risky and dangerous there. But the devil's in the detail, and there's a lot of work going on about, defining the fence and defining what colour it is and what's in, what's out. Or shall we move things around and shake it all about? So there's a lot of debate about that at the moment. The special resolution regime that was implemented by or suggested in the Banking Act basically asked the banks to pretty much have more capital and certainly have more Tier 1 capital to be able to absorb losses. And there's quite a lot of detail in the sort of the new capital rules, partially linked to Basel III, but there's also suggestions on tougher liquidity requirements as well. So there's new rules on that. And competition. Of course, Vickers was a man who, his background really wasn't finance. His background was competition. So Vickers' background, so he loves competition. And then the final stream of the part of the review is to look at ways, or some ways, of trying to make the banking system more competitive, or parts of the banking system more competitive. So certainly, well, I know all the big consulting firms at the moment are looking to appoint competition experts because they reckon they can sell lots of consulting services to people sitting here probably, looking at competitive implications and competition-related stuff, which is going to be a major, a third theme of this review. The Treasury estimates the costs of implementing the recommendations of this commission is 4 to 7 billion, with a one-off 2.5 billion implementation costs. So it's going to be quite costly, and here this is the time frame. Just to say a bit more about it, of course banks have complained that the regulatory compliance costs will be too high. They'll lose access to cheap retail deposits to fund more risky activities, and this subsidy will mean it's obviously less attractive to do investment banking type activities. Okay. Another criticism is that related to, well, what's in and outside the fence. There's a proposed reform still allows banks to undertake proprietary trading, which they're not allowed to do in the US. So they're allowed to do some pretty risky stuff in the UK still. And it's argued that no limits have been placed on the amount of wholesale funding that can back this. Now what's quite interesting actually, well I find it interesting, you probably won't, but we've got these recommendations from the Vickers Commission. Then we've got the Dodd-Frank legislation in the US 2010, which is equivalent. This is our equivalent to Dodd-Frank, if you like. Poor man's Dodd-Frank or rich man's Dodd-Frank. We've got the US legislation Dodd-Frank from 2010. We've got this. We've got the European Commission. We've got this, what's the guy, Lickerman, the governor of the Bank of Finland, who's also engaging in a review. Well, you know, you can't get 20 people together and say we're going to review and we're going to write recommendations for the the European Union banking system without saying anything. So they're almost certainly going to recommend somewhere between, you know, Dodd-Frank and ring fencing for EU banks, that the German banks and the French banks are absolutely dead against the ring fencing, because they reckon it would really adversely affect their business. So in Europe, we've got another group of people who will be sitting down, and I think they're a bit late now, producing a report on similar themes about this. So you've got the US regs, or Dodd-Frank, you've got the UK, the ring fencing, you've got the Europeans, the EU are going to do something similar. So it's going to be something between ring fencing and Dodd-Frank, I guess. So this is going to substantially impact the funding of wholesale stroke investment banking activity of the major banks. It's going to create a vast amount of work for consultants and lawyers. The implications are going to be quite uncertain, and it's going to take quite a long time to implement.
What else is priority, Phil?
I think from an industry perspective, it's important that, you know, banks drive to try and improve, you know, customer trust in their business. I mean, there's a need to try and improve the perceived professionalism of the industry, the ethical behaviour of people who work in the industry, the ethical, you know, nature of the whole business is, you know, seriously under question, and so there's a need to rebuild that side of the business, although that will be a challenging task.
You know, the major UK banks have to try and keep their shareholders happy, so there's always going to be this pressure to generate profits from an array of their businesses. But I guess that doesn't mean that shouldn't be balanced about, you know, balance with a more professional outlook to the way they run their business. I mean, going back to previous questions, I mean, I think, you know, other professions like you can be a turf accountant without passing accounting exams, but generally you can't be a professional accountant without passing accounting exams, but you can be a banker without it. So I think just the formality of passing professional banking exams enabling you to become a banker means it is a serious profession. Well, it's not regarded as a serious profession now, because anybody can become a banker. You don't have to pass any exams. So I think that's one route that the industry really does have to think. You know, they can focus on generating profits. There's nothing, of course, nothing wrong with making profits. They've got to keep the shareholders happy, but they do have to find a way of increasing, you know, ethical standards and overall professionalism. And I think, you know, the simplest way to increase overall professionalism would say, well, you can't actually work in a bank unless you pass these exams.
So we've heard about the importance of human capital in all of this. What about the individual banker watching us talk today? What part can they play in helping to rebuild the professionalism of the banking industry?
A lot depends on the hierarchy in the bank and the way the bank is run.
Yep.
I think, you know, the impetus really comes from the top. If the people who run the bank say that we have to have a more professional approach to doing business, that will entail all our employees fulfilling minimal ethical professional standards, and part of that must be they must have minimum professional qualifications in certain areas that have an ethical stance or an ethical feel. I think the governance features of banks and the way banks are run is also quite important, and the role of ethics and trust and professionalism probably needs to be stressed more, you know, on a day-to-day basis than
at operational level.
Yeah, at an operational level within the bank, than rather, you know, we'll just play lip service to it.
Okay, final question for you, Phil. In terms of bankers have got an awful lot to manage at the moment, an awful lot coming at them, very complex. But I guess one of the lessons from the crisis is always to have an eye on the horizon. Yeah. What's coming down the tracks do you think that bankers should also be aware of, as well as managing the complexity that's in front of them?
The way that the banks have been run, The regulators have been very liberal in allowing banks to do an array of things, and this has spawned a more innovative banking financial system. And I think up until the crisis it was believed this is a good thing, it's creating a profitable system. Now, sure. Bankers can't be allowed to pretty much regulate themselves. They have to be regulated, they have to be constrained. The proposals in place in the Vickers Commission report, in the Dodd-Frank in the US, legislation on the horizon in the European Union is almost certainly going to constrain banks' activities and try and sort of separate their retail, small business, lower risk type of business, or at least legally try and move it away from the more risky areas of banks like the investment banking and wholesale. Yep. And also the regulations are going to limit the amount of that more risky business banks can do.
You've talked about the fact that more risky business, it's going to have pressure on margins as well, because they're not going to be able to lend based on deposits, retail deposits. So they've got to ring fence the deposits that support the lending as well.
Yes, I mean, this boom in securitization activity could only have been undertaken by the major banks because part of that activity was funded by very cheap deposits or funding costs from their retail customers. Sure. So you were having, little depositors put money in that was helping fund racy investment bank deals in the city. Sure. Now the wholesale activity will, well, not now, but in the future, the wholesale or investment banking area of business won't have access to that cheap array of funding, and so it'll make it more costly for them to do that. So that'll also constrain their business. And it's also quite likely actually that the investment banking, that type of activity, is quite likely that that type of business will either migrate to a completely new standalone industry or migrate to another part of the financial sector.
So some things to think about. Thank you very much indeed, Professor Phil Molyneux.
Okay, thanks very much.